A very good morning to each and everyone sitting over here. I'm Dr. Vibha Jain from Janki Devi Memorial College, Delhi University, and today I'll be taking up standard costing. Now, the question arises, what do you mean by the standard costing? The standard costing is nothing but the costing where you're using the term standard. Now, in the case of the standard costing, first of all, let me define you what do you mean by the standard. But before that, I want the answer for this question. The question is, have you ever wondered whether it is a summer or a winter, the restaurants are able to supply you palak paneer at the same price? Now, you just tell me, can you think of an audit firm which charges different amount for the audit job depending upon the fact whether the job is going to be done by a trainee or a CA? Now, the answer of these questions you will be able to find out under the heading, the standard costing. Because there you are standardizing the cost and then you are taking the things. That means, can you read this? That is, do you think that while evaluating the performance of these workers during the rainy season or some other season, this is the main point, we should use the same parameter for the performance of the evaluation? I'm just asking you all these things. And this answer of all these questions will be available in the standard costing. Now, just see, it's a method of a control. It's a technique that is which compares the standard cost with the actual cost. And definitely when you are comparing the standard with the actual cost, either some positive variations would be there or some negative variations would be there. And therefore, with the help of those variations, we'll be trying to evaluate the performance. This is the main thing. Okay, now when we are trying to evaluate the performance, that we have to find out that this is again a costing system that involves the accumulating of the cost of material, labor and overheads on the basis of this thing. Now, the basis of standard cost. Why? Because remember what we are saying, the ultimately objective is to control the cost. And the cost is mainly composed of three main elements. One is the material, second is the labor, third is the overhead. Now, if we control this separately, all these three components, automatically the total cost will be controlled. Okay, now that means what we will be doing, we'll be comparing the standard cost with the actual cost, and hence we will be getting some variances, and those variances can be positive, it can be negative. And therefore, we have to find out that why these variances are there in order to make the control. Suppose I say that the standard cost is that standard cost of producing one unit is suppose 25 rupees, but the actual cost is coming out as 28 rupees. Now I come to know that yes, there is a 3 rupees variation, but in order to make the control, we have to find out that what are the different reasons for the variation. Now remember, when I am trying to find out the reasons for the variation, that means I have to find out which are the factors which are affecting the cost. And I have just told you that the factors or the component of the cost are material, labor and overhead. And therefore, what I'll be doing is, first of all, I'll try to find out the standard cost of the material versus the actual cost of the material, the standard cost of the labor versus the actual cost of the labor, and the standard cost of the overhead versus the actual cost of the overhead. I'll compare all these three things and then I'll try to find out that out of these 3 rupees, which is the major cost, whether it is the material cost, whether it's the labor cost or whether it's the overhead cost. And therefore, we have to understand the difference between the standard cost and the actual cost, the estimated cost and the budgetary cost. Therefore, we are coming for this analysis, we are coming to the word that is the variance analysis. Okay. Now, first of all, before coming to the details of the variance analysis, first of all, let's try to understand that what is the difference between the standard cost and the estimated cost. Remember, the standard and the estimated, both the costs are for the future. That's the common point. But the standard cost is what should be the cost, and the estimated cost is what would be the cost. That is, the standard costs are scientifically determined. Now, what do you understand by the term scientifically determined? That means, suppose you have to stitch one shirt. The shirt takes 2 meters of a cloth and 1 meter of a cloth comes out to it at 100 rupees. That means what you will say, 200 rupees worth of the raw material should be consumed. But now estimated is on the basis of the past performance, you will find out how many units of the raw material you will be needing and at what price you will be needing. There in the standard, it is a scientifically proven, while in the estimated, it is based on the previous past adjusted for the future. Okay, these are the main things. But here it is what should be the cost. But in the previous case, it would be what would be the cost. Okay, now what would be the cost? What will be the cost here? That means now remember here in the case of the budgetary, in the case of the estimated and the standard cost, it is determined for each component of the cost. While here it is for a period of time. Please remember that it is for the period of time, while the standard is per unit. While in the case of the standard, it is a regular system of an accounting, while it is used as a statistical tool. Okay, these are the main differences between the standard and the estimated cost, which is really a little bit confusing because both relates to the future. But now, if we come to the another thing, that is the standard and the budgetary control or the budgetary cost. It is the standard cost. I have already explained that it should be that what should be the cost is called as a standard. While here in the case of the budgetary control, both the methods, whether it's a standard costing or a budgetary control, both have been used for the purpose of the control. But here it is that it is used with respect to the manufacturing unit, while the budgetary control is with respect to all the departments of the firm. That is, whatever the activities are there, according to the activities, you will find out the budget, you will set up the budget. Here, it represents the predetermined cost, while it represents to the entire activity, how much should be the cost. Okay, here it is primarily in the accounting system. Here I'll be trying to find out the variances, but here I'll be trying to find out that what would be the planning mechanism with respect to the control mechanism. Okay, that is the main difference. Here it cannot exist without budgetary system, but yes, budgetary control can exist even without the standard. These are the main differences which you should really understand. But now the question arises, what could be the possible types of standard? Standards could be broadly divided into mainly different types. It can be 3 types, that depends upon my purpose. But here mainly for our purpose, we'll take the 2 main type of standard. One is the personal based and another is the word record. That is, under this ideal condition, what should be the cost? But remember, for the practical point of view, those ideal conditions are never there. Okay, therefore, under the present condition, what should be the cost? That would be the standard, the personal best cost. Okay, now here, how the standards have to be developed. We will take the historical experience into account. We will take the engineering study. We will take the engineering studies mean the logic of finding out the cost. Then input from the operating personnel and the new information available. That will be these 4 other factors or the basis of which I'll trying to find out that what is the standard cost. Once you have found out the standard cost, we will find out the actual cost, we'll compare the two, and the difference of the two would either be favorable or unfavorable. Question arises, what is favorable and what is unfavorable? I think everybody do understand that favorable situation would be when the actual cost is less than the standard cost, then that will be called as the favorable situation. That is, I have incurred less cost as compared to the standard, provided the quality is the same. Because if we deteriorate the cost, the question is that yes, the actual cost will definitely be less. But remember, here we have to take up the quality constant. And therefore, that would be a favorable thing. But if it is a vice versa, that is the actual cost is more than the standard cost, then in that case, it would be an unfavorable situation. Therefore, never put plus or minus in standard costing. You just write down the favorable or unfavorable here. Now, question arises how to calculate the variances. Now, remember, if the standard cost you have determined for suppose 100 unit and actually I am producing 300 unit. Can I compare the cost of 300 unit with the standard cost of 100 units? No, a very big no. That means, first of all, what I'll suggest you is that first of all, try to convert the standard cost for the actual output. If you convert the standard cost for 300 unit, yes, both the things are comparable and hence we can find out that what is the variances. I'll be able to find out what should be the cost for 300 units of output. Then I have already got the answer that what is the actual cost for 300 units of output. The base is comparable and then we will find out the difference and that will be called as a total variance. Is it okay? Now, then this is what I have written. The standard cost applied to the output produced, that is the actual output. Once I have found out that, then only I can find out the actual variances. Okay? And therefore, the formula can come out as the total variance is equal to actual cost of actual production and the standard cost applied to the actual production. That is, we are producing 300 units in my example. That means try to find out that what should be the cost for 300 units and accordingly I'll compare the two. Okay, once I have found out there, then I can find out the other thing, that is what are the basic components of the cost, which I have already illustrated you in the beginning. The three components of the cost are there: material, labor and overhead. That means these could be the three possible reasons for the variance. Okay, when these are the three possible reasons for the variance, that means we can have either the material variance, we can have the labor variance, we can have the overhead variance, and the total of three variances will be called as the total variance. Okay, now let me start with the material variances first. Okay, now that means you tell me, I'll just ask you one thing, that whatever is the total material variances, what could be the possible reasons for those variances? Either the quantity I should have used is different from the quantity which I have actually used, or the price at which I would have purchased the product or the raw material and the actual price is different. That means there could be only two possible reasons for the material cost variance, and these are the material price variance and the material usage variance or the material quantity variance. You can call it by any name. Fine. Now, if we look upon now material usage variance or the quantity variance can be divided further into two categories. One could be the material mix variance and another could be the material yield variance. Now, if I take the mix variance first of all, try to understand what do you mean by the mix variance. It's not necessary that we need only 1 unit of input for 1 unit of an output. Might be possible that I need A raw material also, B raw material also, and C raw material also for 1 unit of an output. Okay. Now, according to the standards, suppose I have to use 5 units of A, 3 units of B, and 2 units of C for the production of 1 unit of A output. Okay. That means the ratio which I should have used is 5:3:2. That means it is 5:3:2. Okay, this is nothing but the standard. Okay, but actually it might be possible that the actual is 4 is to 4 is to 2. Okay, now you tell me here also I am using 5 units, 3 units, 2 units. That means in total I should have used 10 units for 1 unit of an output. Here also I am using 10 units for 1 unit of an output. I'm just asking you, is it that there would be any variance here? Yes, the answer is yes. Though the total input used is actual total input used is equal to which I should have used, but still the variance, material cost variance will be there. Why? Because there is a change in the mix, and it is not necessary that the price per unit of A, price per unit of B, and price per unit of C is exactly the same. And therefore, even though the total input used is the same, that is 10 here and 10 here, is still the price, still the variance will be there, and that is because of the change in the material mix. Okay. Another thing is that in the case of the usage, there could be a material yield variance. Now, what is yield variance? I think everybody do understand yield is nothing but the efficiency. That is, it's not only output. Generally, the students say that it is an output. It is output per unit of an input. That is, what is that? That what is the efficiency level? That if I use 10 units of an input, I should have produced 1 unit. Fine. But actually I am using 11 units of input for 1 unit of an output. Output is same in both the cases. The actual output is same as the standard output, but the inputs are different. Now, can I say that the efficiency level is the same? No, the efficiency level is not the same. That means the yield is different. Therefore, there could be 2 reasons. That is, change in the mix could be one reason why you are using more or less quantity than the standard quantity, or it can be a yield. The efficiency level could be the another reason. Efficiency of operation can be another reason for finding out that how much the input we are needing, how much the input we are needing for the production of 1 unit of an output. And if it is so, let's discuss that how these things have to be calculated. Okay, that means in total, how many variances we have to find out. The first variance we have to find out is the material cost variance. Then, in the previous slide, we have already discussed that cost variance can be because of the 2 reasons. One could be the price variance, another could be the usage variance. That means another could be the usage variance. Then usage can be subdivided into the mix variance here and the yield variance here. Okay, that means now let's discuss what are the formulas for that. Remember, the formulas have very logically been written over here. You have not to cram it up. Let's just see. Material cost variance. I told you that variance is nothing but the difference between the standard and the actual. Okay. Now, if the actual cost is more than the standard cost, it would be unfavorable. And if the standard is less than the standard is more than the actual, it would be a favorable one. Just see here. And the another point which you have to always remember is the quantity for which you are calculating the standard cost and the quantity for which you are calculating the actual cost. That quantity should be the same. I cannot compare the cost of 100 units with the cost of 150 units. Therefore, the output should be the same. Okay. If it is that, therefore, the formula, what is the formula then? The standard quantity for the actual output into the standard price, that becomes the standard cost for the actual output, minus the actual cost for the actual output, that is the actual quantity into the actual price. That is how you will be able to find out if the standard cost is less than the actual cost, it's unfavorable because I have incurred more expenses as compared to what I should have incurred, and therefore this would be an unfavorable situation, while if the reverse is the case, that will be the favorable situation. Another thing is, now this has got 2 components, one could be quantity, one could be the price. Now, if the reason is a price, then the formula will become the standard price minus the actual price into the actual quantity. Here you people should not do the mistake of taking up the standard quantity here. Fine. Because the difference in the cost will come out on the basis of the actual quantity purchased and not the quantity which I should have purchased. Okay. And that is the reason why we have to take the actual quantity here. Another important point, whatever is the name of the variance, remember that has to be subtracted. Here it is the price variance and therefore the two prices have been subtracted, that is the standard price minus the actual. Here the cost variance is there, therefore the two costs have been subtracted, that is the standard cost for the actual output minus the actual cost for the actual output. Here the name is the usage variance. If it is a usage variance, then the two quantities have to be subtracted, and remember again, it has to be the standard quantity for the actual output. When it is the standard quantity for the actual output minus the actual quantity, again the output is the same. Okay, you have taken the same base, finding out the difference and then multiplied by the standard price. Is it clear? Now after that, the two reasons could be there. I have already explained it to you that it can be a mix reason or it can be a yield reason. Now, if the mix is there, then in that case, what I'll be doing? I'll be finding out in the standard proportion. Just see, the actual quantity in the standard proportion. If the standard ratio is suppose 2 raw materials you need and the standard ratio is 3:2. But actually I'm using in the ratio of 5:5. Now what I have to do? Whatever the actual quantity we are using, that we will convert it into 3:2 only, and then we will take the actual quantity in the standard proportion minus the actual quantity in the actual proportion. Now the two quantities we will subtract. Now just see, the proportion we have changed, the ratio we have changed, and therefore we'll be able to find out that what is the difference, what is the variance because of the change in the ratio, and therefore multiplied it by the standard price. Okay, but the yield variance is nothing but, please ध्यान रखिए एक चीज, all these first four variances are with respect to the input, but the yield variance is with respect to the output. Okay, and therefore what you have to do, you have to write down the formula as standard material cost per unit of an output. This is where you have to be very, very careful, and generally students commit error. Now, here I have taken the word output, while in these four I am taking the prices or the quantity with respect to the input. That means, first of all, try to find out what will be the standard cost for 1 unit of an output. That is, we have found out that is the standard material cost per unit of an output. Then another thing, it's an output side. That means actual output from the actual input minus the standard output from the actual input. Why? Just see, in all these four I have taken standard minus actual, but here I am taking the actual output minus the standard output. The base is here also the actual input. The base here is also the actual input. In both the cases, I am calculating with respect to the input. But yes, I am taking the actual output minus the standard output. Why? Because remember, if I am producing more actually output as compared to what I should have produced, okay, is it a favorable situation or an unfavorable? It's a favorable. That means you are more efficient, okay. And when it is more efficient, the formula has to be the actual output for the same input minus the standard output from the same input. That is, if suppose 100 units of the input is there, actually I could be able to produce 20 units, but the standard said you should produce 18 units. That means I'm more efficient, and therefore it's a favorable situation. My efficiency is more. As a result, the formula is like this. Now, if it is there, let's illustrate it with the help of an example so that you can understand the calculations also. Now just see, read. A manufacturer is producing alloy for which the standard mix is 25% copper and 75% iron. They have not given the quantity, they have given you the percentage. Now the standard price is given to us, that is, it is 80 rupees and 20 rupees. Then what they are saying, 20% of the input is a standard loss. That means if you are putting up 100 units, the output would be only 80 units. That is what it means here. The actual output is 800 kilogram of alloy, that is 2000 kilogram of the copper and 90 per kilogram and 90 per kilogram and 9000 kilogram of iron at 15 per kilogram. Okay, now here we have to calculate all these 5 variances. Now here by mistake it is point lag gaya hai, but please don't consider it as a point. It is 8000 kilograms. Okay, now if we take up this question, how to solve it? It's my advice that in the standard costing question, first of all you prepare a table. That makes our task very, very easy because we are getting the ready-made data. It's not necessary, but it is definitely advisable to make the table first. Just see. And in the table, we will be making for the standard and we will be making it for the actual. Just see. Now here, if you remember the question, they have not given the actual quantity. They have given me the percentage, 25% and 75%. That means, first of all, I have to calculate the quantity. In the quantity calculation, if you remember, they say 8000 units of an output we are producing. Let's find out how much should be the input for producing 8000 units of an output. Just try to understand 20% loss is there. That means the output is 80%. If 80% output is, just see, in a very simple way, if I calculate in a very simple way, then can I say it? Just see the calculation here. Just see. Now I have to produce 8000 units of an output. This is 8000 units of an output is there. For this, how much will be the input I'll be needing? Because 20% is the loss, that means the output is 80%. I want input. Input is 100%, then the output is 80% because 20% loss is there. If I calculate that, the output that is 8000 into 100 by 80, it comes out to be 10,000 units of input. If this is the 10,000 units of input is there, then they have said out of the total input, 25% should be the copper and 75% should be the iron. That means here I have taken 10,000 ka, I have taken what? I have taken the 25% of 10,000, that is 2,500, and 75% of 10,000, and that is 7,500. The selling price they have given it to us, we have multiplied it by that is 2,500 by 80. Then in that case, I'll be getting the total standard cost of copper, total standard cost of iron I have calculated just by multiplying it, and this becomes the total standard cost. This becomes the total standard input. Okay, this becomes the total standard input. Okay, here similarly I've calculated the actual material cost. That is, this has been given to me. This has been given to me. Just see, this has been given to me. The actual price is given to me, just multiplied it. That becomes the actual cost. That becomes the actual quantity, the total actual quantity. Now with this table ready, now I'll be calculating all those 5 variances. Now all those 5 variances, I think it's a time to recapitulate. Material cost variance is nothing but, I'm again repeating, it is the standard cost of the actual output minus the actual cost for the actual output. Because actual cost is always for the actual output. Therefore, in the formula, we never write down actual cost for the actual output. Just see, this is the formula I have written. Now, I've just substituted the values. Just see, the values have been substituted. Now, when I'm substituting the value, just see what is the standard cost and what is the actual cost. The standard cost calculated is 3,50,000. The actual cost calculated is 315. I've just subtracted the two, and that shows that 35,000 favorable variance is there. If I've written, why if? Because just see, the actual cost is less than the standard cost and it's a favorable situation. Now the cost is being divided into the price and the usage variance. Just see, the price variance is, I told you, the difference of the two prices, that is the standard price minus the actual price, multiplied by the actual quantity. That is, in the case of the copper, we have, just see, 80 minus 90, that is the standard price minus the actual price I have taken and multiplied by the actual quantity. What is the actual quantity for the copper? Actual quantity for the copper is nothing but the 2000, and therefore I have multiplied it. Now just see, 80 minus 90, that is, it's an adverse situation because I should have purchased at 80, but I am purchasing at 90. I have paid more. It's an adverse situation, and therefore I have written A. For the iron, it's 9000 into 20 minus 15. That is, it's a favorable situation that I have purchased at a less price per unit as compared to what I should have paid. Okay, and therefore the total comes out to be 25,000 favorable. Okay, when it is like that, afterwards I told you that cost has to be divided into the price variance and the usage variance. Now the usage is how many units you are using for that much output. Okay, that means the two things should be subtracted, and if you go back to the previous slide, you must have seen that 2500 is the, just see, 2500 is the standard quantity and the actual quantity used is 2000. In the case of iron, it is 7500 and 9000. This is the same figure which I am taking it here and multiplied by the standard price of the respective raw material that is coming out here. Just see, here the standard, I should have used 2500, but I am using 2000 units only, and hence it's a favorable variance. While this is the adverse variance, the total usage variance comes out to be 10,000 favorable. Have you understood? Okay, now remember, just go back to the previous slides where I have told you that material cost variance has been divided into the price and usage. That means if I go other way around, the price plus usage should be equal to the cost. And that is what I'm proving it here, that material cost variance should be equal to material price variance plus the material usage variance. I've substituted both the values which I have calculated, that is 25,000 favorable and 10,000 favorable, and hence the answer comes out to be 35,000 favorable. Just look upon the material cost variance which I had calculated previously. If I just show you the previous slide, the cost variance is 35,000, and here also I am getting 35,000. That means the results have been verified. Okay, now we have understood that the usage variance would be divided into the mix variance and the yield variance. And the mix variance, I have told you that the standard price into the actual quantity in the standard proportion. Okay, that now I have to take it up. That is total, how much the actual quantity I am using? 11,000. What is the standard proportion we are using? 25% is to 75%. That means I'll take up 25% of in actual quantity, 11,000. That comes out to be this much quantity. For the iron also, I am taking, total actual is 11,000. I am taking 75% of that, and that is coming out to be this much. Now I'll be using these two quantities for the purpose of calculating the mix variance. Just see, the standard price into the standard quantity minus the actual quantity. That we will take into account. Then hence it comes out to be this much. Here also in the same way I have used this much, and therefore the total material mix variance comes out to be the previous one, that is nothing but this one. Okay, this is 45,000. Now the last variance is material yield variance. In the case of the yield variance, I told you it is from the output side, while the first four are from the input side. The yield variance, the formula is the standard material cost per unit of an output. What is the total cost which we had calculated in our table? That was 350. And how much is the output which I am producing? The output I am producing is nothing but, what is the output I am producing? output I am producing is 8,000. When I am producing 8,000, I've divided it by 8,000 and hence that is the per unit cost has come up, and here it is the 11,000 the input. How much is the proportion of the output? Out of the 11,000, I am taking 80% of that. That means 8,800 units I should have produced with 11,000 units of input, but actually I am producing only 8,000. That means I am producing 800 units less than what I should have produced. What is the value of 800? That is multiplied by the standard unit cost, that is 43.75. Just divided this, you will be getting 43.75, multiplied both the thing, and therefore I'm getting the yield variance as 35,000 adverse. Now what is the verification? How I can prove that this is correct? And these are the only reasons for that. If I just write down this equation that material usage variance is nothing but material mix variance and the material yield variance, the summation of these two, just substitute the value. One is I'm getting the mix variance, I'm getting 45,000 favorable, yield variance I'm getting 35,000 adverse, and therefore the net shell will be 10,000 favorable. And do you remember what was my material usage variance? Just look upon where I have calculated 10,000 favorable. Okay, here also I am getting 10,000 favorable. By just doing this verification also, I am doing 10,000 favorable, and this is how we calculate the variance. Here what we can conclude, that if the left hand side is equal to the right hand side, that means these are the only two reasons why I am getting the cost variance. Just I am repeating, in the case of the cost variance, the two reasons we have analyzed is the price and the quantity. And for the quantity variance, the two other reasons are the change in the mix and change in the yield, and therefore the material usage variance has to be equal to the mix and yield variance. Okay, thank you very much.